A few weeks ago, I found out a uranium company I own shares in entered into a billion-dollar merger. So naturally, I did what any uranium investor would do in 2026. I opened up Claude and I asked it. Because here's the thing, if I'm going to invest in the pickaxes, I might as well swing one. 3 hours later, I'm elbow deep in a 356-page corporate filing, learning what an exchangeable share is. But what I found is, buried in Appendix C, bankers said that this stock after the merger should be worth $3.38. The share currently trades at $2.81. Is this an opportunity or a warning? Turns out the answer wasn't even in the filing. Let's get into it. Okay, little roadmap here. We're going to take you through a brief history of the uranium market, what a royalty company is. Then we'll go through the actual merger. We'll talk about the numbers that I saw that got me excited and the risks that I had to consider and my hunch on why it's trading so cheap. But more on that later. Now, disclosure. I own shares in this stock. I'm definitely not a professional, and this is definitely not financial advice. Claude read this filing with me and answered my embarrassing questions. But I felt it was important to admit that because what I got wrong is where I learned the most. Again, not financial advice. I'm just a guy who apparently reads Canadian securities filings for fun now. Little uranium history for you. Starting in the mid-1990s, there was an approximately 20-year program known as megatons to megawatts. This is where the Soviets supplied the U.S. with about 500 tons of uranium extracted out of about 20,000 nuclear warheads. At its peak, this supplied about half of U.S. nuclear power. Now, this was great for world peace, but terrible for uranium miners. Why build new uranium mines when there's fuel showing up at the docks? And fast forward, March 2011, Fukushima. Japan shut down their nuclear fleet. Germany decided no more nuclear for us. The price of uranium dropped from about $70 down to right around $20, and it stayed roughly there for the better part of a decade. 2018, Cameco, the West's largest uranium producer, suspends activity at McArthur River. That is the biggest high-grade mine in the world. Remember that. We'll talk about that later. It got to the point where mines were only providing about 60% of what reactors actually burned every year. This is called a structural deficit. The rest was coming from stockpiles. And the issue with stockpiles is they eventually run out. While those stockpiles were running out, the story started to change. 38 countries now pledged to triple capacity by 2050. And don't forget about AI. Data centers need clean, always-on power. And it turns out that nuclear energy provides the lowest life cycle carbon footprint per kilowatt hour produced out of any electricity source. And that's not the industry's numbers. That's coming from the UN. Meta and Microsoft have signed multi-decade contracts with nuclear power plants to supply them directly. And then Kazatomprom, the world's largest uranium producer in Kazakhstan, is cutting their 2026 output by 10% to keep supply tight. Uranium currently sits at about $85 a pound. So you have a tight supply and a rising demand. That's the backdrop. So the company in question is Uranium Royalty Corp, if you haven't pieced that together already. UROY, ticker symbol UROY. UROY does not mine. They are a royalty company. If you don't know what a royalty company is, it's basically a legal loan shark for mines. They put cash up front in exchange for a cut of the revenue for the life of the mine. They don't pay the workers. They don't fix the equipment. They don't worry about cost overruns. They just collect. Think Paulie from Goodfellas, if the racket was project finance instead of protection. But to give you an actual example, in 2021, UROY paid $11.5 million for a royalty on McArthur River and Cigar Lake, both owned by Cameco. The McArthur River one basically pays 1% on a 9% share of production. I know that's confusing, but in plain English, it's basically a very tiny sliver of a very big mine. Let's say McArthur River sells $1 billion in uranium in 1 year. UROY's cut would be just under $1 million. Now, that's not a big check, but it doesn't cost them anything, and the checks show up every year. Now, take 24 of those royalties from the US, Canada, Namibia, Spain, add a physical stockpile of uranium that they have in storage, and that's the company. Now, obviously, they paid money for these royalties, but how do you put a value on them? You take how much the mine's going to produce, over how long, and for what price. And then you apply a discount. Basically, the further out in time that money is coming in, you shrink it a little because $1 today is worth more than $1 a year from now. And the further off into the future you go, the less you have an idea of what's actually going to happen, which is known as risk. And the whole process of doing that is called discounted cash flow. Think about it this way. If discounted cash flow was a machine, the number it spits out would be net present value, NPV. You take all those royalties' net present values, plus the cash, plus the uranium, subtract the debts, and you basically have the NAV, or the net asset value. You take the number of shares in the company, and you divide that number by the shares, and you have the NAV per share. Going even further, you can look at the price each share is currently trading at in the market, and you can compare that to the NAV per share, and you have what is known as the PNAV. If you have a PNAV of 1.0, the market is paying the actual asset value. If your PNAV is less than 1, the market's buying it at a discount. If it's more than 1, they're paying a premium. Now remember PNAV. We're going to come back to it again. All right, so what's the actual deal? Well, on April 16th, a merger was announced between Uranium Royalty Corp. And Sweetwater Royalties. Sweetwater Royalties is a privately owned royalty company that owns royalties on trona, which is refined into soda ash. Sweetwater is owned by Orion Resource Partners and the Ontario Teachers Pension Plan. Yep, teacher retirement plan. They also own a very large land position in Wyoming. If you're like me, you've probably never heard of soda ash. Well, basically it is sodium carbonate. About half of the sodium carbonate is used for making glass, bottles, windows, and increasingly glass for solar panels. The other half, detergent, water treatment, baking soda, and lithium for batteries. Is it glamorous? Nope. Is it necessary? Absolutely. And chemicals necessary to civilization make for very durable income. Currently, 70% of the world's soda ash is made synthetically, mostly from China, which is dirty. The process, not China. 30% of it is mined from trona, which is cheap and cleaner. Now, the Green River area of Wyoming is the world's largest deposit of trona. It supplies the U.S. approximately 90%, and it is the lowest cost supply in the world. Demand for trona is expected to increase by 2 to 3% a year till 2030, with a caveat that supply coming online from Turkey and China may depress the price a little longer, so even in the actual corporate filing, they're not assuming a full recovery of the trona price until about 2036. This deal also comes with 4.5 million acres of mineral rights in Wyoming, as well as 850,000 acres of land they own outright. Okay, now what are the terms of this deal? All right, so UROY agreed to pay Sweetwater a lump sum of $330 million in cash, plus 223 million new shares of the new company. This changes the ownership makeup of the new company. UROY shareholders before would own 100% of UROY. Now, because these entities are being combined, UROY owners will only represent 41% of the company, whereas the Orion Resource Partners owners will be 43% and the Ontario Teachers Pension Plan will be 16%. If you own UROY right now before the merger, your shares will convert 1-to-1 to the new URC. Same shares, a smaller slice of a bigger pie, means your ownership becomes diluted. And the trade-off for this is you get a new royalty stream on a different commodity. The vote for this is on July 20th, which more than likely already happened. So, another section I found in the filing that was very interesting is called the fairness opinion. And that's basically where they paid a bank a fee to decide whether or not this deal was fair for both companies. And in this particular case, the bank was Paradigm Capital. One detail I liked is that Paradigm was not paid a fee if the deal closes. They were paid a flat fee no matter what, which incentivized them to be accurate, not to want the deal to close. The most interesting thing in here, and this is what I was talking about at the beginning that really piqued my interest, there was a NAV table in the filing. And basically, Paradigm said that UROY's NAV per share before the merger was $3.02. After the merger, $3.38. That's a 12% difference. As a shareholder, that was very interesting to me. And the reason why it goes up is actually pretty interesting. At the time that this deal was signed back in mid-April, UROY's share price was about $3.64, and that is what both parties agreed to value the UROY shares at. And because they agreed to value the UROY shares at $3.64 a share, that means they only had to issue 223 million new shares to Sweetwater. Now, let's say they had valued the UROY shares at the actual asset value of $3.02 a share. That would have meant they would have to issue 46 million more shares. And now, because they agreed to the deal at the higher share price valuation, the existing UROY shareholders don't have to eat that extra dilution. And that is basically where that 12% comes from. Look at it this way. You were basically taking both companies, combining all their assets, increasing the share count by 223 million. You take the total assets for both companies and you divide them by the new share number, and that's where you get that $3.38. And that's why it is accretive for the existing UROY shareholders. Like I said, I found that interesting, but I didn't wrap my head around that right away. When I saw that, I basically asked Claude, like, hey, this is arbitrage, right? Free money? And I was politely corrected, no, this is not arbitrage. Arbitrage needs what's called a forcing function. In this situation, a forcing function would be if they agreed to pay a dollar amount for each share. Let's say they agreed to pay $3.38 per share, and the market was trading well below that. Traders would see that opportunity and they would buy it up to that point, and that's what a forcing function would be. But because they're just trading in shares, trading one share of the old company for one share of the new company, and even though everyone agrees that the new share's asset value is higher, that doesn't guarantee there's a buyer. You only get money when somebody buys your share. And just because it's considered more valuable doesn't force anybody to pay for it. So what this actually is a bet on a re-rating. And a re-rating deals with the PNAV from earlier. So basically, right now, if you look at UROY pre-merger, it's trading at 281 versus a net asset value per share of 302. That's basically a 0.93 PNAV. If the stock price stays there after the merger, that discount would widen to 0.83 PNAV. And that's the thing, is there's no guarantee that the market will pay the net asset value per share. It's a bet. It's not a guarantee. And that's why it's not actually arbitrage. After that, I wanted to see what the analysts were saying about this. Let's see, Raymond James, 4 days after the merger was announced, raised it to outperform, and their price target was about $4.46. The average U.S. listing analyst number was about $4.35. Seeking Alpha had an independent analyst saying $4.50. And remember, these are not their targets for right after the merger. These are their 12-month and in some case 18-month forecasts. And that's the thing, is just like how the merger doesn't guarantee you that the share price is going to sell higher, an analyst bet doesn't guarantee that the price is going to go higher either. These are all just bets with a varying range of payouts. Separately from that, in the fairness opinion, Paradigm cross-checked its own NAV math in a second way. It compared UROY to its royalty peers in the mining sector. And what it found was that mining royalty companies generally trade at a PNAV of 1.0 to 1.2. When you take the net asset value per share of the new company, valued at $3.38 a share, and you apply that 1.0 to 1.2 PNAV, you end up with 338 to 406, which is kind of in the ballpark of the analysts. Again, this brought up one of those questions from the beginning. Why is UROY undervalued compared to its peers? Why is it currently at a 0.83 PNAV when its peers trade at a 1.0 to 1.2 PNAV? I have a theory about that, but first, let's go through everything that could go wrong with this deal. All right, so that filing I keep going back to also has another section, 10 pages of risk factors. Now, this isn't done by Paradigm. This is done by UROY, and it's the things it's the most worried about. Number one, the vote. It needs 3 separate approvals. First, a 2/3 supermajority of all the shareholders. Then, a separate majority that excludes insiders. This would be the minority vote. And thirdly, a Canadian court has to sign off on the whole deal. Now, if any one of these fails, the company can walk away. And again, this vote is happening on July 20th, which more than likely happened before you watch this video. Number 2, dissent rights. Canadian law lets shareholders that oppose the deal demand a cash out at fair value. If more than 5% of shareholders do this, the company can walk. Number 3, there is no financing safety net. If the deal goes through, UROY owes them the money no matter what, regardless of market condition. And number 4 is called overhang. Under the new ownership structure, former Sweetwater royalty owners now own 59% of the company. And if you think about it, you have a private equity firm and a teacher's pension plans. Neither of them are considered forever holders. A private equity firm selling is its business model. That's how they make the money. And a teacher's pension plan, as far as I know, I don't think retired teachers can eat a uranium share. There's a deal in place that says they can't sell for 2 years. But because 2 years isn't that far off, the market can see this coming. And I wasn't familiar with this term, and a good analogy that made it make sense to me is, imagine you own a house and you're not necessarily trying to sell your house, but you are concerned with its value. And now you have a neighbor who, in about 2 years may sell his house. And that makes you think about how much your house is worth. If that house goes on the market in 2 years, your house might be worth less because of it. It's, simple supply and demand. Now, imagine you have 223 million new neighbors, and they all might sell their house in 2 years. That worry would be hanging over your head, hence the term overhang. And so that is an actual risk, and Paradigm also flagged it themselves as a risk. Number 5, and this one just sort of is what it is, maybe the discount never closes. Royalty companies can trade below their value for years. There's an old expression, the market can stay irrational longer than you can stay solvent. And that's the thing, is nobody's forcing anybody to buy anything at a particular value. And number 6 listed in the risk factors is you're basically watering down your leveraged uranium play with the stability of a soda ash check. This is even mentioned verbatim in the filing, less near-term exposure to uranium price upside. Let's get back to that part about UROY's valuation. As an optimistic investor, I didn't want to believe that this was the market rejecting this deal. And I had a hunch that it wasn't. And full disclosure, I wanted this hunch to be true. As investors, we're not supposed to let our emotions do the thinking, but sometimes they take the wheels. But I wanted to be unbiased about this, so I had Claude check my bias against the charts. I pulled up UROY's chart, obviously, but I also pulled up both of the big uranium ETFs. I pulled up UEC, and I pulled up Cameco. And I fed all their charts to Claude, and I said, hey, do these charts look the same? And, spoiler alert, they look the same. UEC, same chairman, no merger, down 50%. Cameco, down 30%. Both ETFs, down 15% in a month. The nuclear ETF, down 21%. Same shape, same dates. UROY isn't the exception, it's the rule. There's a term for that. It's called sector beta. It's when a whole sector moves in concert. It's not one company, it's the whole sector moving together. And here's another interesting part of that, is uranium itself during this time period barely moved. It held pretty strong at about $85 a pound. And beyond that, in April, the long-term contract price, this is the price that the utility companies actually pay, those hit $91.50, which is the highest since 2012. That doesn't look like the market rejecting a deal. That doesn't look like a dying industry. That looks like money leaving a trade. Let's look at the timeline here. In mid-May, you have what looks like profit taking after a bull run. Then fast forward to June 17th. This was Warsh's first meeting, and he turned out to be hawkish, flipping the narrative from expecting rate cuts to expecting rate hikes. And rate hikes are poison for a speculative commodity trade. And then in late June, you have an AI sell-off. The AI ETFs started selling off, the semiconductor ETF started selling off, and basically now, for better or worse, uranium is considered part of the AI trade. That's why I made that joke at the beginning. Another interesting one is during this time, the Dow hit an all-time high. The market wasn't crashing. The the money was just rotating away from rate-sensitive commodities and the hypest trade of the day. Uranium was both of those. There's also the mechanical element to this. UROY sits inside those uranium ETFs. When somebody sells those ETFs, the funds that operate those sell a little bit of every company in the basket, indiscriminately, regardless of company fundamentals. And what I realized is nobody buying or selling an ETF is looking through a corporate filing at a NAV table. A little bit of positive news right here is when I looked at UROY's chart right after the announcement on April 16th, it did go up for about a month. That told me that the market was initially positive about this merger deal. But I took a step back and said, hey, if I'm going to blame sector beta on dragging UROY down, then I should be intellectually honest and make sure that sector beta isn't dragging it up as well. So when I went back and looked, turns out that the whole sector was already falling by April 16th, and UROY actually diverged from the sector for about a month after the announcement. And eventually, sector beta caught up and began dragging it down. But there was a period of time where UROY diverged from the rest of the sector, and that was right after the announcement for about a month. Also, something I almost missed. On page 3 of that filing, remember that 4.5 million acres of mineral rights? One of the board's own reasons for doing this deal was what they called enhanced uranium optionality, plus critical minerals, plus oil and gas. None of that's in the asset value calculation. That's basically a free lottery ticket on uranium exploration stapled to all those soda ash checks. And again, since I mentioned intellectual honesty, something else I should mention is that you can't really separate sector beta and deal-specific concern. The overhang, the dilution of the uranium exposure, both of these things can be true. It's hard to tease out where one ends and the other one begins. And another thing, while looking at these charts did make me more optimistic, that is still not a guarantee that I'll get paid. And it certainly doesn't guarantee any timing. All right, let's bring this home. Uranium Royalty Corp is absorbing a soda ash royalty giant. The math adds 12% value to each share, while the shares are currently trading at a discount. The best explanation isn't that people hate the deal, it's that the whole sector is experiencing a rotation, with evidence that people might actually like the deal. And disclosure again, I own shares in this company. This is not investment advice. This is just research for your sake and mine. Reading through this filing and learning what was in it taught me more than I think I've ever learned about investing in that same time period. I am not a professional. I'm learning in real time in front of you. It took me multiple revisions of this video. Turns out I can't read from a script. I had to go through and learn all of this so I can talk about it naturally. And my hope is that it helped you learn too. Please, if you disagree with anything I said, leave it in the comments. And if you made it this far, regardless, I appreciate you. Genuinely. If you like this kind of video, please send me the market signals. Like, subscribe, comment, and I'd be happy to make more. Thank you, and I'll see you on the next one. All right, so a royalty company, a private equity firm, and a teacher's pension fund all walk into a bar.